everyone. This is Omar Khan. I'm the founder of Boardwalk Wealth. And the whole purpose of the State of the Union, these videos, is to give you a background on trends, markets, plus our case studies. What are we looking there? So ultimately, you can invest successfully in 2025 and beyond. And the theme here for this State of the Union, but I also feel for investing this year, is going to be uncertainty creates opportunities. I'm joined by our very dapper, direct from Europe, Chief of Staff and Head of Investor Relations, Eric Wong.
Hey everybody, well, thank you, Omar. I wanted to present a different look this time around. Although I'm not from Europe, not direct from Europe, but I'll take that as a compliment.
Oh, really? I really had you confused there for a second.
No, it's the sweater. It's a sweater. But anyways, we're excited to cover the next or State of the Union. And as everyone knows, there's been a lot going around in the world, a lot going on, a lot of changes, a lot of anticipation. There's a lot of excitement and also some trepidation. So Omar, we're hoping to get some of your insight and dissect what is fact and what is fiction. Today, we'll cover leading multifamily trends. Next, we'll have an exploration of the markets in the Sun Belt and the Midwest. And finally, we'll provide some actionable advice to vet risks and rewards in 2025. But before we do that, Omar, why don't you give our listeners a little bit of summary of your background and why you're the right person to dissect what is going on in the media and tease out fact from fiction from the headlines.
Great. So look, guys, I'm a CFA charter holder. For those that don't know, the CFA is a gold standard in portfolio and risk management, 17 years of experience across capital markets and real estate. And when my team gave me the script, I saw the word, 17 written there. I realized how old I'm becoming. So I guess that gives you some idea. Some of this gray hair is due to all the work we've done. $3.75 billion in capital financing and M&A transactions. And on the multifamily side, our team has done over $760 million just in multifamily transactions, 3,900 plus units, 29 projects, 19 acquisitions, 10 developments, raising over $150 million from institutional and private capital sources. Now, on transactions, we've gone full cycle. We have grossed 26.6% IRR, 2x equity multiple, with an average holding time of about 36 months.
Well, Omar, as they say, time stops for no man, but you're still looking good with the distinguished gray. It's because you work so hard. On that note, let's move on to our first topic. First topic we'll cover is leading multifamily trends. So there's been a lot of uncertainty, and people always say, for example, Warren Buffett, the adage is investing during uncertainty is mentally painful, but ultimately this time can be the most rewarding. So Omar, can you talk about multifamily permits, the number of permits and deliveries, and how this could lead to promising opportunities in the near future?
So first of all, guys, you've got to understand permits are a proxy for supply hitting the market. Regardless of what industry you're in, economics 101 always applies no matter what market you're in, demand and supply. We're going to focus on these, but the reason why I want to tell you why this is important is because this helps us look out into the future to understand, okay, how much supply is hitting the market. So permits, no surprise, nationwide have drastically fallen. This is a lagging effect of the last 2 to 3, a little bit longer, feels way longer than 2 or 3 years, of Fed hikes finally taking place. Now, this is something that's obvious. Not a lot of people realize it though. Real estate and private equity leveraged businesses. This is why interest rate movements, especially when they go up, make it harder for projects to pencil. Another underappreciated aspect of this entire scenario over here is interest rate volatility. When I explain this to people, conceptually they understand it, but in reality, they don't really get it because people want a clean, crisp answer, and we know the world doesn't work like that. So look, here's the deal. It is not just the absolute interest rate that matters, but the volatility of interest rates. And I'll explain this to you in a very simple example. Think about it. When we are putting a development together, we're putting an acquisition together, even at its fastest pace, this project, this whole bringing everything together is going to take a couple of months. So if you're penciling something at an X interest rate and volatility, and usually when people say volatility, it's upside volatility on interest rates. That's what makes it worse. If volatility is very high, so let's assume you pencil a project at 7% interest rates, and now volatility is so high that rates are 10%. Well, all this work that you have done is not going to work out because your project isn't going to pencil. Conversely, the rate could be 8%, but it is not volatile. So you know with your eyes open when you're going in what to do. You can then make plans accordingly. Because rates have been so volatile, because they've been going up and down, mostly up, that is why projects that could have penciled in the current environment, sponsors and investors alike are very skittish. They don't want to pencil those projects. So the volatility of interest rates is also causing a lot of these permits to fall. And then lastly, as less projects get done, there is more uncertainty. And it is exactly at the moment when uncertainty is at its highest, that's where the greatest opportunities present themselves, because frankly, that is when you have the greatest amount of pain. Minimal deliveries are projected. This is not specific to one market. This is a nationwide performance. Now, on the screen, you're going to be seeing reports, CoStar reports of supply and deliveries from various markets that we're tracking. Now, CoStar is a very well-respected third-party data. The reason why this is important is because I want to show to you that this is a nationwide trend, that deliveries are down. They are expected to go down. Some markets more than others, obviously.
So our team has been tracking these trends internally as an indicator of potential rent growth. So, Omar, after a year of basically zero rent growth, what do these trends say to you?
Well, as I mentioned, regardless of what situation we're in, Economics 101 always applies. And this is why supply and demand and then the associated rent growth stories are linked. Deliveries, as we've seen earlier, we're going to talk more about it, they are expected to dwindle. But in my opinion, personally, not as much as the industry is hoping, because hopes and dreams are oftentimes what drives our actions. Not ours, but the industry's. Now, as deliveries, if the market expects the deliveries are going to dwindle way more than what we personally expect, they're also underwriting to more effective and aggressive rent growth. Why is this important? The reason why this is important is because housing affordability continues to be an issue regardless. And what's happened across the board, and this is not just linked to, say, the coastal markets or specific pockets, everywhere, Midwest, coastal markets, Texas, even places that were affordable earlier till a few years ago, they have housing affordability challenges. So here's the deal. A lot of sponsors are counting on these minimal deliveries, but high demand being still there to underwrite to very aggressive, effective rent growth rates. They are using this as a justification to pencil their projects. But here's the issue. I don't personally think that's going to happen. A lot of smart operators agree with me. Being ultra aggressive, if you're an operator, within us, we are operators. This is just not in our DNA, because we understand that actions have consequences and one has to live with the consequences for multiple years. It's not a you do something right now, you take all these steps and you can unravel it. So here's the deal. Because being aggressive is not in our DNA, this has helped us to avoid a lot of the carnage that has leading the market in the market right now. We chart a middle path, we hope, and do all the work to make sure that this middle path, we aggressively stay on this middle path and don't go out of our lane.
Okay, so let me just summarize what you said there. So you're saying that the trends are pointing to rent growth being possible and even probable, but not a significant enough or a major factor in getting deals done.
Yeah, that's a measured way of putting it, yes.
Okay. So let's go to an investor question. So there was an investor question that's pertinent to, related to what you said. How can we trust the latest projections when back in 2020, the glut of supply that eventually hit the markets was not forecasted?
This is an excellent question. And the response is always, you should never rely on one data set or one entity or one individual to base your entire investment thesis. Look, guys, here's the deal. You have to aggressively filter for quality data from multiple sources. You have to create a mosaic to develop an investing framework. This is why I always chuckle, industry professionals always chuckle, when people say something like, I expect the cap rate to be 4.7529. Okay, there is nobody on the planet who can do that. Once you have an investing framework, you're able to understand, okay, the range of values, the range of volatility one can have. Second point, we assess data from various data sets and sources. Doesn't mean we always get it right. Doesn't mean we're always correct. But again, we're aggressively filtering, we're aggressively assessing through our processes, and these continue to get refined as we take investment decisions. Now, I'm confident that many of the projects we operate in, we're going to see some level of rent growth, some tepid, some not as tepid. Can't speak for other people's projects. But again, to restate, we are not doing any deals that would hinge on aggressive rent growth assumptions. In a little bit, we're going to talk about pairing data and trends with other factors.
Yeah, just to summarize that point is that there are very few things that are certain in life. So you take your best data sets and then you make an inference, you work on a range of probabilities as opposed to saying there's some absolute outcome. Because if we had an absolute outcome, then we'd all be rich and we'd don't have to do any work. Would you agree, Omar?
Yeah, I mean, I agree to the point that I would love to be rich without doing any work. Yes, 100%.
Exactly. All right, let's talk about interest rates. So there was the Fed meeting happened in January. We're a little bit out from that. We're in February now. There's another one coming along the way. So Omar, what's your CFA background? Please review the last Fed meeting, what you foresee in the next one, the implications, and what's going to happen for the rest of 2025 in terms of rate cuts or lack thereof.
Look, let me at least go to the last half of 2024 and set the table for how to answer that. Look, in the last half of 2024, when the Fed announced the last rate cut, yields actually rose, which was contrary to what most market experts were predicting. And the bond market pushed these yields up, especially at the end of 2024. Why is this important? Because effectively, commercial real estate, people, multifamily, private equity, VC, anybody that's lending or the recipient of lending, they don't basically take the rate that the Fed offers the banks. What we basically do is get priced off bond yields. So if you see on the screen, you will see in the last 3 months, especially if you look at the last 6 months as well, how much rates have risen for 5, 7, and 10 months treasuries. These are typically the reference rates on which our loans are then basically priced off of. Rates have come down a little bit in the last few days as of this recording, but they are up materially. Now, here's the deal. I personally don't expect rates to be materially lower in 2025. The industry is hoping, especially in private equity and real estate, for lower rates, because obviously helps us do deals, makes our lives much easier. But let's be realistic. We are locked into this vicious cycle where if rates come down, inflation, the specter of inflation can creep up. And if that happens, then all of the work that the Fed has done so far goes to waste. And the Fed is very, very, very cautious and hesitant about the inflation reappearing in the same way that reappeared a few years ago. Guys, realize no Fed chair wants to go down as the Arthur Burns of their time. Rates are likely to stay elevated above what sponsors need to bail them out from the mess created in especially at the end of the last cycle. We are already seeing this. We are seeing capital calls, pref equity calls, which are basically capital calls, just with a different name, happening everywhere, institutional all the way down to private capital sources. This is going to happen. But all of this distress, as we mentioned right at the start, all of this distress creates opportunity. You cannot go forward by looking in the rearview mirror. Okay, here's the deal. We've capitalized on some of this distress in our portfolio of takeovers in our special opportunities fund. We've closed on about $120, $140 million of transactions between 1,300 to 1,500 units as of this time of recording. We have bespoke agreements with lenders to restructure and recapitalize deal. How this is happening is because we've got a world-class management platform that allows us to step into deals to materially increase valuations, because frankly, there's just not a lot of operators that can do what we do. And as a result, we are providing an accretive solution for borrowers and lenders alike by using the power of our platform. For the longest time, it did not make any sense for operators to spend money on operations. In fact, if they took more money, put it towards marketing, they could raise more dollars and effectively do more deals and get more fees. Well, that tide has changed. Here's the problem. Hangover strategies from ZIRP era, zero interest rate era, they've got to go. Okay. The expectations of projected returns also, everything's got to be 25, 30% IRR. That's also got to go. We're going into a more normalized interest rate environment, which is not necessarily reflective of what happened post GFC.
Okay, so Obviously, stats, numbers, quantitative evaluations are very important and informative, but you need to balance that on actual boots on the ground insight. So can you talk a little bit about the proofs we've gleaned from our operations and then do a quick case study?
Of course, look, stats, there's a really famous saying, there's three lies in the world: stats, stats, and damn stats. Stats are only one piece of the puzzle. We need to pair it with consistent action. Too often, equity partners, capital raisers, investors, they like to pick and choose stats which make themselves and their projects look good. Asset managers and operators like us, we're boots on the ground. We do not have that luxury because we understand when we take decisions, we have to bear the consequences of these decisions for years on end. We don't have a luxury of reading a report from 3 or 6 months ago when the data is collected. We see the data as it comes through every day, every week, every month. So a lot of what you've heard in the last few years is trailing data reports. It's like driving on a highway looking in the rearview mirror. You just can't do that. And today we're going to offer you some contrary insights. Let's balance these trends we've discussed with a case study from one of our Atlanta properties, because specifics, I feel, they can get lost in a sea of aggregates, but specifics are often just as impactful because you need to understand what is going on the ground. So Eric, our European head of investor relations and chief of staff, can you introduce the deal in DeKalb County in Atlanta?
Yes, but before I do that, let me just correct you 1 second. It's actually 3 types of lies, damned lies, and statistics. So
yes,
there you go. Okay, so we're both numbers guys, though, and we're both history buffs. So let's bring up a fallacy called the McNamara fallacy before we jump into this DeKalb County case study. So the McNamara fallacy, it's also known as the quantitative fallacy. It refers to Robert McNamara, for you history buffs out there, who was overseeing both the Ford Motor Company and the Vietnam War. And as we all know, that didn't turn out very well. And it involves decision-making that's based solely on metrics and declaring that whatever can't be measured doesn't exist. So in other words, we're ignoring things that are difficult to quantify but are actually important. So how is that relevant? Well, I come from a healthcare background, so we saw this all the time where we defined in clinical trials, the measure of successful outcomes would only be based on survival rates, but nothing else. So you wouldn't consider quality of life. So in other words, this was an incomplete strategy because you're not looking at the complete picture. So how does this tie back to our property in DeKalb County? This is a property that we acquired in 2022 with significant value add potential. We also have a property management team that's based in Atlanta and it's successfully helped us manage multiple properties there. In addition, we have a series of in-depth trackers that tracks all property metrics. We slice and dice everything. Miles' team, the asset management team, and yourself, we meet with the project management team weekly to review and tackle all actionable items, review all the statistics. So from that, the result from takeover is that we've increased our average rents by $200. We actually now have an actual slight gain to lease, meaning that we're at the top market for our rents. In fact, the lender visited the site recently as part of the refinance process, and they said that they found a renovation and maintenance process exceeded their requirements. So all the measurables look great, but what about the unmeasurables? So for that, Omar, I'll let you take it from there.
So this is going to be a case of, just to stay on that government thing, this is going to be a case of what an ex-Secretary of Defense, I believe, Donald Rumsfeld said, these are the unknown unknowns. So here's the deal. The issues here, regardless of our performance, lie with the county. They have decided to not press any evictions in 2023 for most of 2024. It is next to impossible to deal with county. They have blamed COVID. Pretty much every operator in this county is in some shape or form suing or has sued the county. Word got out that, hey, you don't really have to pay. it has inculcated and created a culture of squatting. You could be a top operator, by the way, we are in the submarket, and still have this destroy most of your profit. We have massively outperformed comps on occupancy. Occupancy is consistently around the low 90s. And as Eric has said, we have top of the market rents. That's why we have a gain to lease. But again, because of county issues, this change in culture, this weird culture that has been created by the county, I want to use the right words here. Lenders have straight up said that they don't want to refi into this county until a change of leadership. And they're not saying this in coded words. This is very plainly said. Everybody knows about it. In fact, the northern suburbs of Atlanta, we're talking Alpharetta, Johns Creek, Suwannee, deep southern suburbs like Fayetteville, had a great asset there. We sold. Peachtree City, Newnan, these are phenomenal places. Good, right balance of landlord and resident-friendly policies. We've actually had great success in the Atlanta metro. Great success. Investors have made a lot of money, but here's the problem. This change in culture with the leadership, the area stats did not catch up to it until it was too late. And I can tell you this right now, we will never buy in this county again at any price. I don't care if the county is giving stuff to us for free until the leadership has turned over, and they have demonstrated with their action a complete 180 degree in the way they deal with their affairs. Nobody's saying that you just want landlord-friendly laws at the expense of resident-friendly laws, but you need a healthy balance. What you can't have is a culture of squatting that is not good for society. That's not good for our bottom line. And by the way, that's not good for residents, because if landlords are not making money, they are paying less in taxes. Less services can be provided to residents. Residents do not get quality, affordable housing. And this affordable housing crisis we are in the throes of this. This keeps getting worse and worse. You need a balance. So stats and trends can tell what a county has, done in the past, but they aren't going to save you if you have a complete cultural change right at the top and you just have these cuckoo policies that make no sense at all.
Yeah, we try to stay away from politics, but Omar, you're calling a spade, and really, there's a lot of.
I don't think it's politics to call a spade a spade. 2 + 2 is 4. It doesn't mean if you're on the left or you're on the right.
Yeah, and unfortunately, like you mentioned, there's this myopic view that's harming everybody. But let's segue from that. Let's go to the next topic, which will examine some of the markets that we operate in. So let's go to the next section. So let's start off by examining the darling multifamily region, which is the Sun Belt. Omar, the Sun Belt has perpetual rent growth, and deals that are done there are guaranteed winners, right? Guaranteed.
Yeah, trees grow to the sky, Eric. That's a very subtle joke there. I see what you did, you European person. I'd like to think by now most of our audience doesn't believe that anymore.
Okay, but we still love the Sun Belt, but we want to caution people on certain things. So in all seriousness, please tell us about the drop in deliveries and maybe touch on the bevy of distressed takeovers that we've undertaken and why.
Look, Sunbelt has opportunities, and a lot of people think it's the only place to do deals, as Eric was subtly pointing out. But it's not the only viable place to do deals, as an example. We will consider many submarkets in the Sunbelt. Look, I live in Dallas. Technically not really part of the Sun Belt because Texas is Texas, but you get the point, right?
Oh, hold on. You're telling me Texan that. Oh, my goodness.
Hey, Texas,
cut that out.
Hey, I'm not a native Texan, but I think I can speak in this regard. Texas is Texas. It's not part of the Sun Belt. It's not part of the Midwest. Texas is Texas, okay?
There we go. We don't be angering anyone from Texas.
Okay. So we will consider many submarkets in the Sun Belt and Texas, but it is now a lot about other factors beyond the area's history and statistics. For instance, most of these submarkets are showing a drop in deliveries. We discussed that earlier, but that's just not enough. For instance, Florida and Texas, they remain a minefield because of high insurance and property tax costs. There are parts of Texas, parts of Florida can't even get insurance. In Georgia, like I said, we need a little bit more time, county by county. It's a bit more trust but verify sort of a deal to see on their statewide commitment as well to at least landlord and tenant balanced legislation and policies because of how badly we've been burned by DeKalb County. Personally, we don't love it. Arizona, there is a lot of volatility. Things go up crazy, things go down, and a lot of the winners tend to be early cycle. There's a lot of pride around timing. And as you know, that saying, pride hath come before a fall. But that being said, with prices significantly bottoming out in Arizona, there's going to be a lot of pain. But full disclosure, we might look at something there if prices go down even more. But right now, we really haven't looked at anything there. Opportunistic basis is what is the name of the game right now, rather than, this sub-market has this cool little feature. We are not exclusively doing deals in the sub-market, and as of this recording, we're not starting our targets just on sub-markets or areas, but we're looking at where it's mismanaged. Ideal situation would be the CapEx is done, all of this is done, but you just have really bad management, because we can use the brains for free, and I like free stuff. So I want to use my brains to solve a problem and not just throw money at a problem, ideally. And of course, the municipality at a minimum has to have resident and landlord balanced policies. You cannot sway one way or the other, because then the pendulum swings back. Cheap debt was a major driver of Sunbelt success. We're already seeing this with all the syndicator blowups. You need a massive amount of leverage to make Sunbelt deals work. And that's just not going to happen these days. Deals for us have to be a no-brainer. With fixed debt, that's it. Although, it would be sexier for me to come out and say, we have this deep data mining and data research, and I have a joke. We're going to use artificial intelligence in everything we say. Our artificial intelligence has pointed out to this one can't miss submarket. But that's not really the case, guys. We are operators. We understand how this business works. We've closed on about 10 opportunistic assets in our special opportunities fund, 1,300 to 1,500 units in just the last few months. Some of them were in the Sunbelt, but some of them were outside. So opportunities still exist. We have grouped these together under our fund. We can provide more disclosure and all of that, but just remember, we don't expect every property to be a home run. It's a numbers game. We're looking at it as a portfolio. Distressed situations from distressed sponsors. We offer accretive and balanced solutions for borrowers and lenders alike by utilizing the power of our management platform and our reach. And I got to take my words back. In earlier 2024, I proclaimed 2024 was going to be the year of the operator. I've got to take my words back. This is the era of the operator. And when you pair up discounted property valuations with the power of our platform that drives occupancy, collections, additional revenue streams, expense efficiency, well, then you've got a workable solution that works in this high interest rate environment.
Okay, so I want you to confirm one thing, that some of these distressed acquisitions are also in the Midwest. Is that correct?
Oh, yeah. We've looked at a few distressed acquisitions in the Midwest. On the whole, it's a lot steadier, though. The majority of the work we do in the Midwest is on developments. The Midwest doesn't boom like crazy, but it doesn't crash like the Sunbelt. And in terms of this region, we feel the most value that Boardwalk Wealth can add is through our reserve style projects. These are buildings that are Class A adjacent quality for middle-class residents. These are high-quality residents that always pay on time. And the issues that we are facing in places like DeKalb County, they are mercifully non-existent in the Midwest. Guys, here's the truth about the Midwest, but generally true about just this capital raising sort of business. Here's the deal. The Midwest is a less known and less sexy market. And frankly, it is harder to raise money for Midwest deals because enough people don't know about it. And you have to understand, from an operator developer point of view, capital raises, not operations, deliver money up front. Capital raises are the lifeblood of the business. So the incentive for a lot of Sunbelt operators is to keep doing deals with aggressive assumption. Keep doing it till the model literally breaks down and implodes, and that's exactly what's happening. Because you can use your brain, create opportunity, and go to a less sexy market. Yes, it might be harder to raise equity, but when you look at the long term, when you take a long-term holistic view, it is the better option, especially because there's less competition and better demographics. Again, this is an issue where one has to overcome initially painful mental hurdles, and one has to look at the long-term aspect and results of their actions, as opposed to how can I do a deal to get fees right now?
Okay, so let's talk specifically about our own darling market, Sioux Falls and the surrounding area. This is actually a good time to bring up another investor question. So let's see, what is this? Okay, fair enough. I don't know enough about Sioux Falls. why did you choose to build there?
That's a very good question. And that started with another question that we asked ourselves. Can we scale to where the puck is going? We also have two great construction and design partners, Dustin and Caleb, that we've successfully transacted with before in past deals in the Sun Belt. And that provided us ample competitive advantage because they're homegrown talent. Why don't we jump into Sioux Falls section, really give them specifics? And I believe that might properly answer the question.
Okay, let's review a couple pertinent stats and I'll give it back to you, Omar. So population growth, Sioux Falls in 2024 is 2.66%, which was paired with massive drops in multifamily permitting, which was more pronounced in other major markets. And Sioux Falls also had the lowest unemployment rate in the country. July 2024, it was 1.6%, and then in August, 1.9%. Before that, it was tied for number one for 3 months, and it continues to be right at the top of that stat. Go ahead, Omar.
Well, fans of Spinal Tap will understand this when I say these markers are like other darling markets, but turned up to 11. It's had more sustained growth than Dallas, Austin, Atlanta, Tampa. There's diversified economy, high-paying jobs for long-term margin of safety, guys. Here's the deal. There is less competition, less risk, because while you have a home run potentially in other markets, you can also have a dud. Here, it's steady Eddie all the way through. And when you combine these demographics with the steady Eddie nature, you are going to get solid deals over the long term. This is not a 1 year, 6 month play. This is why we don't get too cute around timing. These are typically 3 to 5 year holds. Don't get too cute around timing. But the intangibles are converting to tangibles with the repeatable process. Here's the deal, guys. Look, I've got these notes here, so I'm going to read off some of the stuff here. Sioux Falls works great for us and our investors because it's not a one-size-fits-all solution. We are blessed to have two exceptional partners. They are local, homegrown talent with exceptional capabilities and track records. Each of us brings a unique skill set. My partners have excellent local networks. We invest our own resources. We've got the power of the Boardwalk Wealth Management platform, which aligns interests along all stages. My partners live and work locally. We get community feedback. We understand what's going on. And specific projects we understand have to work in a high interest rate environment. We have iterated several versions of these reserve style projects each step of the way. We call this core amenities focus. Let me go down and I can actually tell you exactly what's going on. We take these core amenities, we divide them into phases, we divide the units across several buildings. What does that do? We remove extraneous amenities. We make our amenities very local and specific to the demographics. We partner with capable local businesses that provide other amenities. So it's a win-win solution for everyone. And the point is that we are doing this because these projects still work in today's market. A lot of the developers are from the zero interest rate era policies where they're just going to keep throwing things against a wall. This is why their projects are not penciling out. To give you some context, we are delivering the first units 8 to 10 months, entire projects 14 to 16 months, and 90 to 95% occupancy, 15 to 18 months. Hard cost of construction are mid 130s to 140,000 a unit. Compare this to the standard development that takes 18 to 24 months just to deliver. So even if you take it at the lower end, which by the way, nobody ever delivers at 18 months, by the time people are delivering their projects, we are already fully stabilized on these projects. This is why we can create so much value.
Okay, that definitely answers why we developed in Sioux Falls, South Dakota. So before we move on then, let's dive a little bit deeper. Let's do a case study into one of our projects, Briarwood Reserve. Omar, let's do a comparison for the audience here. So you had our team do a deep dive into a few other development deals on the market right now, and particularly one that is offering pref equity positions to finish a development. Okay, I'm not going to name any names because we don't do that stuff, but the broad strokes are definitely illustrative.
Yeah, look, we can be discreet while still getting the point across, I think.
Okay, so I think it's fair to say that it's been frustrating for us because often investors they're getting burned in other deals, and then they will kind of have that mindset for all developments. So if one sponsor's development is falling through, then they take that as that's the usual development timeline, has the same risk for all developments. The process is broken, and this frankly hurts us. So to keep it brief, I saw development in a so-called hot market that started raising money in 2020, and at the end of 2024, it still had not completed construction. It had very little occupancy, it was nowhere near stable, and it was offering pref equity positions to keep the deal alive. So all I want to say is that it does not need to be like that, and our developments are not like that.
Yeah, look, I have the stats with me, so this is one. Let's take the case of our Briarwood Reserve project. We started building Briarwood Phase 1 in the northwest of Sioux Falls, I think around June 2023. We delivered first units in February 2024, just 8 months from the start of construction. Leasing these units, we pre-lease them, so start around month 6. You can have people move in day 1. Start leasing these, and in July 2024, we finished the entire construction. By December 2024, we were 100% occupied. Now that's 18 months from the start of construction to be fully leased up. And now we're underway on phase 2 we have institutional as well as private capital partners, exact same business plan, pretty much the same timeline. And the last point I'll say on this is leasing at this velocity allows us to turn over our leases. This is a very underappreciated aspect if you're not an operator. Think about it this way, guys. If you've got this typical tower that takes 18 to 24 months, nobody delivers in 18 months, but they say that their typical loans are 3, maybe 4 years. So think about it this way. We're going to take the midpoint, not exactly the midpoint, but 20 months, between 18 and 24 months. So somebody's delivered the project at 20 months. It's still going to take them, if they're lucky, 8 to 10 months, most likely about 12 months to lease the project. If you're at a 20-month mark, you've taken 12 months to lease a project, no, you are at month 32. And every development, ours, other people's, typically when you're leasing up a project, you have to give some sort of concessions. Now, if you have a 3-year loan, you are screwed beyond belief. But if you've got a 4-year loan, think about it. You are fully leased till month, say, 32. So now you have maybe one more turn of your rent roll, but not likely, because if you want to get out of this loan, if you can't sell it, you are probably going to initiate a refinance around month 40 because you got 6 or 8 months. Here's the deal. You just, as an operator in this old model, have not been able to turn the leases enough time. Whereas for us, if we have the same 4-year loan, by month 18, we are already 100% or at least 90 to 95% occupied, but we started leasing in month 8 to 10. So by the time we are going to year 3 or 4, we have turned over our leases 2, 2.5, maybe 3, 4 times. Why is that important? Because with each turn of the lease, you are getting up to market rents, you are fully maturing out your revenue streams. That allows that if you are in the position to sell or refinance, by the way, you have maxed out. Hopefully you are at the peak of your valuation, which then allows you to either sell or go for a refi and extract as much money possible, hopefully through a cash out refi. This is something that a lot of people, they learn pretty later in the game. It's important to understand. And this is why, look, frankly, we've had to pivot as well. We've done these other projects. Obviously, these bigger projects, elevator type projects, these look very nice in our brochures. But we're in the business of making money, not taking nice pictures.
Yeah, I think that's really important to point out the fact that we're able to do these similar style projects. They're essentially the same projects, the reserve style. We've done them so many times. We're able to iterate this. We're able to improve this. So there's fewer surprises. So then, for example, like you said, the lease renewals, the rent raises and the like, it shows that we're able to do this consistently. And it proves to the lenders that we're in a stronger position to negotiate. So we're able to do this rather than just once. We can do this over and over again. So with that said, let's move on to our last section. So Omar, you're going to be giving some advice. Well, let's try not to say advice. It's some suggestions, some information for 2025 investing and how investors can vet the true risk and the potential reward of some of the deals. All right, in the third and final section, we will be vetting risk and rewards. Omar, I think it'll be helpful to start by talking about the prevailing zeitgeist that in the multifamily space. Let's put another way, what are some of the emotional perceptions that are masquerading as trends?
Look, a major, I'm trying to find the right words here, polite words here. Look, because I'm very empathetic to this, that's why. A major one that I see is that the well look is frankly quite poisoned against development, thinking back to the example we just discussed, because people that are burned, they rightfully feel that pain, and they think that is reflective of the entire industry when it's not. It is reflective of potentially a poor choice in vetting a particular sponsor, or by the way, you could have done a great job in vetting a sponsor and it just could be bad timing.
Yeah, as we mentioned earlier, people say with really strong conviction that developments never get done on time, and they always need to raise more money, and so on and so on. Omar, what are your thoughts on that?
Well, look, here's this mantra. I think a lot of it's on social media: ready, fire, aim. It's a pithy quote, sounds very good if you want to use a motivational quote, or if you're one of those people. I am not, thankfully, that likes to have motivational quote posters put up on their walls. Thank God I'm not one of those. My wife would divorce me if I was one of those people, right?
Are you sure about that? Let's take a look. You have your
I am 100% sure. Look at this. There are no cheesy motivational quote. I don't know how to show you that. Yeah, you see, there's no cheesy motivational quote posters. I don't need motivation. I need to get up and do my job. And what I tell people is, you don't need motivation. You just need to shut up and go do your job, which is what I do every day, right? I don't blame people for having this perception, because at least in their case, this ready, fire, aim issue, this hasn't really worked out. Developers are out there starting projects saying they are shovel ready, but without permitting in place, not raising enough money to finish because, hopes and dreams. And they're dragging out construction, hiring showy property managers, don't have an asset management platform. And then they are struggling to pre-lease because their true talent, by the way, is marketing. And this is not a dig on marketing, guys. Without marketing, a lot of other stuff doesn't exist. But everybody, as I keep telling people, everybody can't be a leader. A leader has to have followers. If all you are doing is marketing, you are an empty vessel. Unless you are a marketing company, in which case you're doing a great job. So here's the problem. There isn't necessarily a trend of developments being unnecessarily risky. Rather, what needs to be done is better vetting of sponsors.
Okay, so high level then, how does an investor go about vetting a sponsor?
Look, if somebody's saying the project is shovel ready, make sure that it's fully permitted, zone, entitled, truly shovel ready. And I want to see some alignment of interest through construction to operations. As an example, are the partners we are over here, we have fully vertically integrated this. So my construction partner, GC, is part of our general partnership team, signs on the loan with us. Lots and lots of risk. Risk is where interests align. We also co-invest in our project. So co-investment from all partners is very important. Again, no one item, but what you want to see is a framework or mosaic of alignment of interests.
Yeah, it's very important to figure these things out before just declaring that developments don't work, or that this doesn't work for me, or all developments are terrible.
Yeah, look, there are legitimate reasons why a development might not fit your investing criteria. And I'm looking at this over here because my team's given me a lot of really interesting content, feedback from various investors we talked to. I want to say, look, first of all, I'm very empathetic. I've done deals invested with other people that have lost money. And yeah, it sucks, right? It sucks because this is a sum of your sweat, blood, and tears. But here's the deal. Developers might not be a fit for your strategy. If you're simply not comfortable with the timeline of a development versus an acquisition, that's totally fair. This is why, as an example, we offered phased investing into the same projects for this reason. We talked about Briarwood phase 1. We started phase 2. This gives people a sort of a blended acquisition and blended development for half the project with the accelerated timeline of the types of projects we're building out. Trade-off here is that investors who get in earlier typically get bonus shares. They might get better split of the profits. But hey, you can't win every battle, but you get the option of doing either or both. The struggles that we've had to overcome are, it's a soft market. I don't want to give the impression that we are the only developers in the game who are doing this. Look, frankly, there are no new ideas in development. I know this is hard for people to imagine in an environment where the world is so rapidly changing. But development is still very much a dollar and cents game. There are frankly no new ideas in development or real estate, and they haven't been for the longest time. We look at what's working, and like life, we model ourselves on positive role models and don't model ourselves on negative role models. So market is soft, projections are a little bit off, rents have had to be reduced. That will hopefully likely change in 2025, but for sure in 2026. But we can control what we can control. So we are finishing the construction on schedule. We're leasing up ahead of schedule. Even though we might be coming in slightly below on rents, we're making that up on fee income. You always have to have a platform that can do this. But it's a constant learning curve. Investors' concerns from past experiences. I've spoken to more than a few people who are interested in developments, but they invested with other sponsors. Those deals, as you mentioned, took years, if at all, to materialize. And what we're trying to do here is something very unique that doesn't really happen that much with other developers, because we are fully vertically aligned inside. We are trying to do our part to reverse these perceptions, show not just with our words, but with our actions that it doesn't have to be this way. And developments have always been a major part of long-term real estate investors' portfolio and plans.
Okay, with that said, another contentious topic is the amenities set on a property. So in recent history, most of the capital, especially the institutional capital, has flowed towards luxury developments. And I know that because I'm from Vancouver, a lot of big money here. So Omar, is the only smart play to develop luxury amenity-rich developments, or is there another way?
Eric, we like to call Vancouver the 51st state of the United States, soon to be 51st state.
Soon enough. Exactly.
You will be saved from the follies of your local government. That being said, there is a herd mentality. The prevailing wisdom, especially in the zero interest rate era policies, has been throw as much amenities out there that we can literally afford, right down to the last bottom line. And this isn't simply an opinion of ours. You can check the stats. With the glut of these luxury apartments, as Eric pointed out, as one example, that have been funded in the last decade. But investors have to realize institutional capital, so-called smart capital, these are not operators. These are allocators of capital. It is an allocation exercise rather than an operational one. And you have to remember that old saying, nobody got fired for hiring IBM, that applies equally in these institutional capital shops. The big money opportunities over $50 million, they rely on operators like Boardwalk Wealth because they are allocators, they're not operators. And the trend has resulted in a nationwide issue for nearly all forms of real estate. Tons of product right at the top end of the market, but the middle to lower end has nothing. It's, by the way, a new term that I learned, K-shaped recovery. What this means is people at the top of the market, they've got a glut of offerings. But if you're middle class or lower, you've got, frankly, no offerings. So people are living in two different worlds altogether. And when you factor in rising construction costs, inflation, logistical issues, the prevailing wisdom is that you need the wider margins of luxury products. And I mentioned to you, a lot of this mentality is from the zero interest rate era. Most people listening to this will be familiar with the merry-go-round of value-add projects that syndicators promise. Hey, all you got to do is put a gold toilet and you can basically raise rates by $500. Well, that works till it doesn't. And the consumer is completely tapped out. They have nowhere to go and they have no money to spend on these things.
Yeah, it's important to really know your target audience. So let's put a fine point on this. On a question that we've heard many variations of, which you addressed already, is the commonly held wisdom that you need to max out on amenities to command a profitable rent? So you've already answered that, but let's dive deeper into it.
Look, so my team's given me a lot of notes here. If you see me looking at the screen, that's because I'm going to be referring to these notes because this is a very important topic I feel people are missing. So let's be clear. The types of residents we are talking about. It is true that the commonly held belief is that amenities drive growth. So you need to have an indoor I don't believe in this. You need to have an indoor golf simulator or an infinity pool. Push the luxury up. So about these luxuries, then potentially the market will pay you more rent, da, 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 da. Well, the additional amenity costs are astronomical. And this means the more money is spent on construction, the more a developer wants to charge, or has to charge, by the way, just to make their projects work. The problem is the vast majority of residents want to pay for this. They don't want to live in Section 8 housing. They are priced out of the single family housing. But now they are price sensitive. It's a bit like asking somebody, instead of saying, what are you going to pay for? The question for the longest time people were asking is, hey, would you like to have an infinity pool? And the answer is no shit. Yeah, I'd love to have an infinity pool. It's a bit like if you ask me, would you like to have a private jet? Of course I'd love to have a private jet. But the question is, are you willing to pay for one? No, I'm too damn poor to afford a private jet. So the question really has to be, are you going to pay for this amenity, and not, would you like this amenity? Well, the problem is most of the institutional capital has been asking the wrong question. Hey, as long as we keep throwing these amenities, these luxuries your way, maybe there's this one mythical person out there that will continue to rent from us. The problem is the customer, the consumer is tapped out. Everybody wants luxury. We all want to drive Rolls Royces. We all want to have private jets. But we don't have the ability to pay for these things. So and we're in a dollar and cents game, right? This is not a technology company where you can become a billionaire overnight. So when we are constructing and developing these projects, the first question we ask ourselves is, well, is my customer going to buy this thing? Or am I just going to have a building where I can't even lease up the building in time? By the way, this is happening in most major markets. Just yesterday, I read a news article, I think it was Bloomberg or Wall Street Journal, where in Austin, as an example, it's a poster child for a great economy. About more than half of the apartments right now are offering some type of specials. Apartments have been trying to lease up for over a year. These nice, glossy, shiny buildings, they can't lease up. Nobody is saying, yeah, the cost of your 2-bedroom apartment now is approaching $4,000 to $5,000. How many people out there can afford this stuff? But developers still keep doing it, but because institutional capital keeps saying, well, all the other people did it, therefore it must be a good idea. And I mean, it's just so stupid. We are targeting the affordable middle housing, missing middle housing, as we like to call it. We have tested this with our own money. This is not housing that relies on government grants. For God forbid, who the hell wants to live in government-sponsored housing? We simply found a whole new different approach to the game. You could call it a core amenities, amenity light, whatever you want to call it. What we want to put are boutique style apartment buildings near population centers, near amenities, but not necessarily construct the amenities ourselves because they are so damn expensive. And by the way, that's not our core business. So somebody that has a gym and has 100 of these gyms, they are obviously going to be a lot better at running the gyms than we are going to be running a gym, as an example. That's just the way things are in life, right? Because presumably we're better at building apartments than they are, hopefully, right? So this is what we do. We do location-specific research. We match the construction cost with the demographics ability to pay rent. And from there on in, then we develop. Look, you can set up all the spreadsheets and models in the world. I used to do this for most of my 20s. I worked in investment banking. You can set up all of these projects, can look great on paper. The models look so nice and beautiful with the right colors and the right fonts. And here is the problem. If there are no customers, actual, real humans to pay for your apartments, your model looking nice, your OM looking great, nobody gives a shit. It's a bit like if you are in a market and you go sell, it's a bit like, think about it this way. You could have the nicest Toyota Camry in the world. You could be the greatest salesperson on the planet with the best possible team in the world. And if you price that Toyota Camry for $500,000, and then you don't sell those Toyota Camrys, but you say, oh my God, my showroom is so nice. I have this AI-powered showroom with the nicest paint. Well, yeah, because you have a pricing mismatch. This is not rocket science here. And I mean, I sound like a broken record oftentimes when I say this, but when I talk to institutional folks, my friends at institutional capital, they keep saying these things. And then you ask them, like, Are these projects actually making sense? Like you're doing these projects, are they making sense? No, they're not making sense, but they will in a few years. And that's the
Also,
type of logic you can't just logic against, basically.
yeah, again, Omar, you're a very practical guy, but you also have the theoretical experience. Again, theory does not always match what's in reality. So especially you have to ask the right questions to know the correct target audience. So with that, I want to point out that we don't need to wait for other sponsors to adopt the strategy that we're doing, because we're doing it right now.
Yeah, look, it's a really famous quote. It's probably Albert Einstein or another great American Yogi Berra that said, in theory and practice are the same, but in practice, they're not.
Absolutely,
So
absolutely.
here's the deal. You read my mind. Here's the issue. You have to start looking at a bunch of things when you're creating a framework. You have to see how do you drive really value. Nail that down at a local level. This is still a dollar and cents on a local level game. Check the cost per unit. Give yourself a comparable. Look at how much are other competing projects being developed for. What are they charging? Compare it to what you have. Then it's very simple. So if you're getting a much older building for, say, the same cost per unit as an example, or your sponsor wants to justify a higher cost per unit, be very sober, be very clear, and ask details if the residents will really pay for this amenity, or frankly, can they really even afford paying for this facility, right? Because especially from 2015 all the way to maybe 2021, all you kind of had to do was show up at the party, push up rents because you put some lipstick on a pig, and you made a lot of money. And just because you could do that 3, 5, 7 years ago doesn't mean you can do it now. The market's changed. The world is very different.
Okay, so Omar, give us some bite-sized takeaways for choosing new investments, both developments and acquisitions. On that last point, what about the cost per unit versus amenity set?
Look, here you go. This is what I look for. I'm looking at my notes right now. You got to look at a bunch of things that I mentioned that residents really value. At the end of the day, if your residents don't buy what you are selling, if your customer is not willing to pay the price for what you're selling, it's not the customer's problem. It's your problem. Nail your residents want to pay down to the local level. Check the cost per unit. I'll give you a comparable. We are delivering these brand new core amenity units, hard cost of construction, low to mid 130,000 units. This is competitive with what I see a lot of syndicators and sponsors doing for 80s and 90s vintage acquisitions on a price per unit basis. Totally makes no sense to me. If you are getting a much older building with functional obsolescence for the same cost per unit, or your sponsor wants to justify a higher cost per unit, be very sober. Ask the questions. Will the residents really pay for it? Or frankly, can they even pay for this thing at all? Right? And just because you could do something 3, 4, 5, 6 years ago, the market's changed. You can't credibly do those things anymore. So the game's changed. You've got to evolve and you've got to move with the times.
Okay, well, with that said, let's ask another question. How would an investor assess if projected returns are reasonable? What about this promise of immediate cash flow?
Look, guys, I understand everybody wants immediate cash flow, even when they state the contrary. In today's environment, pretty much most alternative investments, real estate and like, even by the way, public securities, you are not going to get the cash flows that you think you want. Investors, syndicators, by the way, are incentivized to tell you to your face, I've got 8, 10, 12% cash flow. These instruments, especially in real estate, do not exist. You could maybe find one deal a year in all of America. This thing does not exist. I'm an operator. I'm telling you this. It is to my advantage to tell you this thing exists and then just take all your money. Syndicators are manufacturing returns. This is not even a dirty secret anymore. Everybody knows it. What happens is a sponsor over-raises capital. If they need $100, they'll over-raise $20. Then they will pay back investors their own money, but in very small increments along the way. And investors get the nice, warm, and cuddly feeling. And I've literally explained this to co-GPs. I've explained this to equity providers. And you know what they tell me? They tell me, yeah, but it feels so good for the check to hit your account. Guys, why do you want to give your own hard-earned money to some third party only for them to then turn around and give it back to you in slow increments just because you feel really good. Is that the best use of your funds? You have worked hard for these funds. One thing I want to say is, I don't want to embarrass anyone here. It's a sober warning. I have had investors in equity providers alike ping me for high cash flow opportunities. And as soon as I ask, where are they finding these opportunities? Have they deployed this capital? By the way, these are not just retail people, institutional people as well. They admit they actually haven't. All of these, I shouldn't say all, but a significant portion of these high cash flow opportunities end up being Ponzi schemes. There are crypto scams alike. There is a big ATM Ponzi scheme going on where people have lost hundreds of millions of dollars, because you've got to realize, if the brightest minds in America, financial minds at least, in America can't manufacture this thing, what is some guy in some podunk town in the middle of nowhere, how does this guy have a programmatic way of delving this in? Guys, realize it is easy to say yes, because this means you will give money to me. It is harder to say no, but you don't want people that lie to you. And in my opinion, you cannot right now at this stage look at just cash flow. You have to look at total realizations. Cash flow is a smart component of it, but you have to buy quality real estate with quality sponsors, with strategies that work at an attractive basis.
Yeah, unfortunately, if it sounds too good to be true, it probably is. And that brings to mind an old movie, Rounders. What's the quote? It's, if you can't spot the sucker at the table, you're probably the sucker.
Look, it's harsh, but it's true. Get wise fast. You have worked hard for your money. Open your eyes wide. Don't do stupid things. Even if somebody seemingly intelligent is telling you to do this, keep your eyes open. Be very wary. People want your money. They will make false promises on things that do not exist and cannot exist, by the way.
Yeah, there's no free lunch. Let's wrap this up. We've gone over an hour now. It's nice chatting, but Omar, we'll end on this note. Give us a few more pointed vetting questions that investors can ask for current deals.
Again, this is not an overarching framework, just some questions right off the top of my head. We've got some notes written down. Here's the deal, guys, on developments. We've already discussed construction costs, timelines, all of this stuff. Let's shift to operations now. Can these sponsors that are pitching you, whatever investment they're pitching you, right? Can they show, especially in real estate development, can they show a record of lease up within a few months of, within a few tight range of projections amongst their past projects, amongst their portfolios? You're never going to be 100% right, but as long as you're within an acceptable range. Do they achieve stability and occupancy in under a year from the start of lease up? Because if they don't, here's the problem. Your project is going to be underwater from day one. What is the renewal percentage on current buildings? Meaning, are the residents staying long-term? A stable renewal percentage in most markets is anywhere above 50. We target about 60 to 70%. On acquisitions, this one is a lot of guys are actually going to like this. Look at the purchase price, check the loan amount versus the equity, just as a rough measure of the percentage of the purchase price. So think about it this way. If the deal is, say, worth, I'm going to use round numbers just because it makes it easy. If there is a 60% leverage loan, because a lot of sponsors these days like to say, I've got a low leverage loan. In reality, it's all fugazi. If there is a $10 million asset, the loan is 65%. So this means 35% is a down payment. You add a couple of closing costs, fees, CapEx, maybe you're 43 to 45% of the purchase price, right? So your equity is anywhere from 43, 45. Maybe it could be 46%, 47% off the purchase price. But then you look at the equity. Just take the total amount of equity divided by the purchase price. And if that amount is something like 55, 60, 65%, well, set your alarm bells should be ringing. I want to break it to you. That's 110 to 125% of the purchase price. They are over-raising by a significant amount, and they will say words like, oh, we want to be safe. But you know what they're doing? They are taking your money. They are slowly going to give you back your money and say the project is cash flowing, when in reality, it isn't. They are overpaying. These sponsors are overpaying for assets. Only because they want to pad their own projects. They want to take fees without providing any values. There is nothing wrong with taking fees if you provide value. These sponsors are not adding any value. They are taking fees. This, in my opinion, is highway robbery. It is an indication that they need to do deals just to pay the bills. So look, you want to go down this path, do it. But I'm going to paraphrase the late, great Patrice O'Neill. Shortcuts to cash flow are long cuts to your life.
Well, that is a perfect place to end it. If anyone has any questions, they want to discuss what we covered today, if they want to review the financial goals, investment strategy for the upcoming year, you can click the link. There should be a link in the video description somewhere. I want to say thank you again for your trust and for your partnership. Omar, I want to give you the floor for any sort of final words.
Thank you, my European friend. Thank you, everyone. Thank you, everyone, for listening and spending time with us.